Hey guys, Freaky Finance here. This week we're going to do something a little bit different. Well, I'm going to do basically a series of videos. One will be similar to what I normally do. But this video is going to be more about general consumer specific comments so far during Q2 earnings season. And really here is just kind of how I'm kind of showing you guys my process that I generally go through. I listen to calls. Ultimately, this earnings season I'm doing something a little bit different because a lot of the companies, the analyst questions have shifted more into how is the consumer behavior changing during this contraction in GDP period with rising inflation. Well, inflation's been the theme for a while, but now it's more recession focused, right? So basically the questions the analysts are asking are, seen anything different in the consumer lately kind of thing. And so we'll go through it. Some of these companies I'll try to show them. So Alimentation's one that I own. I'm not going to show all the positions, but I'll try to remember which ones I own when I go to that line as I go down really quick. I'm going to try to go quick because there's a lot of companies that I've been following, and it only accelerates. Well, it should start decelerating soon. So anyway, I own Alimentation. I did a video on this one, I believe. It's basically like your Circle K brand if you're in North America, which most of my viewers are. Alright, so basically what I do is I have my little comment here, like mentioned customers reducing gallons filled per visit. From 10 to 12 to 8, and more customers going private label instead of branded products. Generally, that means price sensitivity is more apparent. Customers are adding to visits, but they're filling up less when they go. And then what I do is I kind of have like my little source doc here as I go through it, right? So it's like, what did management actually say on the call? There you go. Our average brief fill COVID, really up until the recent quarters, would have been 10 to 12 per visit, and that's declined to 8, right? So that's kind of like how I go through it. So what I'm going to do is probably go from my little list here to the source. So, and basically here is kind of like, I'd say a mosaic, is that I'm trying to figure out the truth and where the opportunity likely lies that I could probably see in the future, right? Or at least where I'm going to be safer, and which places to avoid currently that we're seeing the most weakness, right? Anyway, so for Walgreens, the shift in spending calculus due to fuel and inflation. Their argument is that they won't cut back on healthcare, which is generally true. That's why healthcare generally outperforms as a defensive sector. But again, Walgreens doesn't just sell health and wellness products. And then again, the source doc is there. I might read some right from the source and some from my comments, but the comments are more summarized, so it's easier to read really quickly. Aritzia, probably the best retailer in Canada at this point, in my opinion, mentioned not seeing any changes in consumer behavior. Only a shift in sales mix trends due to travel and generally opening versus last year. That being said, the inventory was up. And here you can see their comment. They're very much aware of what other retailers are reporting. We're not seeing any changes in consumers' behaviors. Again, Aritzia is more higher end. It's not luxury per se, but it's a higher end, so you're definitely not targeting the lower income quartile for population. And that's a theme we're going to pick up on, so I brought it up. So anyway, Q2 season really start. Usually it's Pepsi and the banks, the credit card companies. But anyway, Pepsi mentioned not seeing a material change in convenience and gas station human consumer behavior, which is weird because Alimentation just said they were seeing it at their gas stations. But when I go through the numbers, you can see that some of the volumes are going down, but they're pushing through really hard on price right now. Like Frito volumes are down, but it looked like there was 14% price takes on that segment. So your chips are getting more expensive, and it does appear that people are starting to respond, even if they don't say it that they are. Delta Airlines, no slowdown. Mentioned international travel still coming back. Domestic is strong. They also mentioned about the consumer maybe struggling on a travel after 2 years being restricted. Go down to Delta here, and then again, I'm not gonna. If you ever want to like freeze it so you can read it and then come back, you can. But it's kind of just how I read through it really quick. My highlighted parts. I thought their comment here was interesting. claiming GDP is up 15% since 2019, but Delta Airlines is only 85% recovered still from 2019, even though they're putting up good numbers now, relatively, or better numbers now, relatively. And note Asia has been horrible with travel recovery still, so there could still be easier comps in 2023 and 2024, assuming they ever reopen and let their public do things. U.S. banks, so this is just a slum of them. So basically, what I do during U.S. Bank Week, so they're gonna get a feel for the general flow of what's going on. So I have my own little tab here for the banks, and basically they all similar theme really. No sign of recession yet, as spending is still pretty high, but spending is elevated more than income, so they're spending more on their credit cards, and so all the banks have reported an increase on their credit card earnings. They have started to increase their credit provisions, so basically a bank can take the hit earlier and basically make a provision that they're going to use up later. And they did this during the COVID panic, and that hurt the COVID panic quarter, but then every quarter after that, once the government stepped in, they reversed the provisions. And one of the things that's very interesting is they're comping against these COVID provision reversals. Well, they're adding 2 provisions right now for this future recession that they're trying to prepare for. And so you're getting this big downdraft in earnings on the financial side, which is pretty interesting. Especially in rate of change terms, it looks really funny when you see the headlines like banks down 35% in profitability, and you look at the number and you're just like, okay, that's all provision from credit losses, really. I mean, that is to say certain banks are more susceptible, so as markets go down, they have to mark to market their investments. That also hits them. So there's other things going on that impact it, but anyway, I digress. As far as the consumer's concerned, they're still spending, but they're spending on their credit cards. It's kind of the main point here. Except for them mention that a lot of spending has shifted to travel and dining. Many of the CEOs tell us that we're on the cusp of recessions. Recession. And most of them echo each other, right? So Citibank kind of echoed Jamie Dimon and JP Morgan. Well, says this could just be a refuel of credit back to normal levels, but could lead, that's my note, but could lead to credit cutoff at some point. The new theme now is that, sure, it might be bad here, but it's going to be worse in Europe. So, and then that's linked to energy prices in Europe coming into the winter here, right? Bank of America says spending on experiences still. Travel and fuel. Okay, we'll go back to the credit cards in a bit. AT&T report. This is an interesting one. I still own AT&T. They mentioned customers are taking 2 extra days on average to pay the bills, which is a $1 billion hit to free cash flow from working capital, which is pretty crazy if your average entire customer portfolio takes 2 extra days to pay, but the hit is $1 billion of working capital. It's just blows my mind anyway. And they've started increasing bad debt expense, so the implied behavior there is that AT&T is lower on the bill priority list. Amex mentions no consumer spending slowdown. Their travel and entertainment growth is still material. Goods is still growing year over year, which is odd because I was kind of expecting goods to keep shrinking, but it is decelerating meaningfully, especially eCommerce goods. But I was expecting it to go down more. Again, that could be credit plugging it, right? The Walmart guide down was pretty interesting during July 25th. So some of these are a little bit dated now, but you can kind of see how my process goes as I listen to a call. We'll just put the customer specific note beside it. Customers spending more on the grocery side with restricted apparel. Walmart doing more aggressive apparel markdowns in half H2. So kind of tells me to avoid apparel, especially on the lower end, as a terms of an investment, right? That's for the weakness. It's already showing up. That usually means it's going to be worse. U.S. Postal Service. This was interesting. So they decrease on average daily volume, which again fits into my goods, less goods being sold narrative. But the price increase was 12%. So they actually the quarter actually looked pretty good, which is interesting as they actually moved less product. They just made more money on moving less stuff. I guess it's good to be the U.S. Postal Service. So yeah, my note here is goods and transportation and shipping is slowing down, but the company is currently making it up in price increases. They claim that half of the 4% decline was them deciding not to take on the goods that they were previously moving, but I don't know. McDonald's able to push inflation. They've been doing this. Actually, probably McDonald's and Pepsi have been the best. They were the first ones to really be on it, in my opinion. Low-end consumers trading down to value offerings and fewer combo meals. So that was the negative. So you can see that, again, they specifically called out the lower-income customers trading down. They still view it that food at home has increased prices more than fast food has, so they still think they have room to increase prices. Visa, so we'll go to the credit cards real quick. Well, I kind of already talked about Amex, but Visa, there's no evidence of consumers pull back in spending. Reiterates the mix shift talked about already from goods to services, and specifically experiences or memories and stuff like that. There's an interesting comment here that stimulus drove up ticket sizes, particularly in the discretionary goods category. So people were spending quite a bit more on goods, especially higher dollar value goods. Banks mentioned more on credit cards, so likely consumers trying to keep consuming but putting on credit or using savings. Likely pushes out an earnings recession, but also likely slower future growth. So that's kind of always been the angle on credit. You don't really know when it's going to go away. So in the meantime, as credit expands, you're still going to see companies put up pretty good earnings as people are spending on credit, right? Until they can't anymore. Until the banks say no more, right? Or the credit card companies say no more. Usually it's the banks. Well, here, loan sharks. Shopify, that was an interesting one. So their goods gross merchant value, so down 11% growth year over year. Still growing, but growing material less than the 40% last year. So when you grow 40% now, all of a sudden you're growing only 11%. All of a sudden you got to do something because you're burning through a lot of cash, especially these growth guys that hire a lot, so they can reduce 10% of the workforce. The interesting comment there is that Toby said mean reversion back to where the pre-COVID growth rate would have suggested. AKA Shopify did not actually pull forward 5 years of growth like they previously said. So that kind of tells you the damage that's being done on the e-commerce side, especially on Shopify's really small business e-commerce, right? That's who it represents. It's the people who use it, mainly. Google, so YouTube growth rate, advertising revenue dollars. So advertising dollars revenue is also the next biggest hit, probably, that you're going to see as we go down. I'm trying to go quick because there's so many. Anyway, growth rate down materially from prior year. Mentioned primarily reflects pullbacks in spend from some advertisers, but they didn't say which industries are pulling back. Other ones will later on. Rogers Canada, no consumer spending slowdown. Roaming is up 130% for 2019. So that was one of the, when I did the Bell versus Rogers bill video, I knew that ARPU was going to come back and these companies do quite well. And that was a while ago. ARPU is continuing to improve from roaming. They're also continuing to improve from the trade up to 5G. Basically, they make quite a bit of money on unlimited plans, and it's generally more per month per user. So it's lucrative for them to keep upselling to unlimited 5G plans. Media is finally profitable again with Blue Jay home games. Rogers owns Blue Jays. I might do a video on the telecom industry again, but again, on the state side, it's definitely a lot cheaper than on the Canada side. But the state side seems to be very competitive with each other. Anyway, I did find this interesting. So they have a net interest expense up $100 million in the quarter versus last year. And that's from $13 billion in debt taken on for lingering Shaw deal. They've already taken out the money that they need to buy out Shaw, but the regulators are holding it up. So in the meantime, they're having to eat this higher interest expense. Facebook seems to have entered economic downturn, broad impact on digital advertising. So we already saw this on Google through YouTube. The situation worse than it seemed a year ago. Reels is under monetized, it's my opinion. And I think it's probably just trying to grow super quick to try to show up against TikTok, which is a big threat. And one of the reasons why the share price is as cheap as it is. Royal Caribbean, so booking volumes in Q2 averaged 30% above booking volume in 2019. So some people are like, are they ever going to recover? Currently, they've already recovered, even if the share price hasn't. Ultimately, I don't like the cruise lines very much. I don't own any of them because they've had to, basically for 2 years, they'd have to have $1 billion in losses that they've had to plug on the balance sheet, which is added to debt and added to shareholder dilution. So that's one of the reasons why I don't own them. But currently, they actually look pretty good. And if they get cheap enough, might take a stab at it. Tourmaline, so this is a nat gas play. Again, some of these don't even relate to consumers, but this is the theme I'm trying to get to consumers. But this comment has nothing to do with consumers. It's just really to do with commodity prices and production cadence, and everything's coming in line. They keep paying out ridiculous dividends, and they currently still trade technically cheap on cash flow, but the cash flows from these high elevated commodity prices. And again, I've slowly been trimming energy and trying to find opportunities in other places that are down 70% versus up 400%, right? Nestle, no direct answer given on down trading. Similar to Pepsi, though, not seeing a material change in behavior and continuing to push price. My note there is kind of weird. Let's see if I have something for Nestle. Walmart, McDonald's, Google, Tourmaline. No, I kind of skipped it. Oh well. I remember it being kind of a weird call. Where they're kind of like blamed everything but consumer trading down to private label. They're like, oh, it was COVID. It was this. It was a weird answer. So anyway, Nestle claims that they're not seeing any trade down to private label brands, or private label rather, versus their brands. MasterCard, very similar to Visa, no pullback in overall consumer spending. Similar increase in cross-border traffic, like Visa's right inflation. You have Fortis. So again, there, no comments or questions. So utilities are a little bit different, as in because they generally, well, they have consumers. It's kind of different, right? Because they have the power, and they're regulated, and that's how you kind of pull them into gear over time. But utilities are doing quite well. No comments or questions on higher rates or consumer businesses. Businesses are still performing in line with the guide. They did pull the Area Lake connector due to the inflation project costs, so we're starting to see project cost impact. So more inflation in their costs, they're going to pull it unless they can get the return that they need from the province or state. I think I've done a Fortis video before. Basically, it's like 10 different utilities. And they continue to try to ask for a higher rate of return in Tuscan Electric, which is just one utility. Back to consumer side, so Diageo, that's your liquor. No slowdown or trade down yet. Mentioned July was still strong. So it's nice when we get to the later parts of the month, because then they'll start giving color on July, which is my Q3. So it's nice when they say that the current trend is. Diageo's been doing well since COVID started, really on the higher end luxury. People are buying a lot of high-end tequila, a lot of high-end whiskey, and they've positioned well for that. It's expensive, I don't own it, but it's interesting just to see that they're still doing well on the liquor side. And generally, sins are seen as recessionary proof, right? Usually people, if you get let go, they're still going to drink, right? Or some of them drink to cope or escape, right? There's a lot of things that are tied to liquor and smoking and other stuff like that during recessions. Amazon mentioned Q2 was subsequently better for consumer demand than Q1, but still lower growth year over year. Note the company's finally seeing easier comps in Q3 and Q4. It was a material winner from COVID during like May 2020 to May 2021. So now we're finally in this, like, I want to say July to September period where we're not going to have as elevated COVID comps, and this is also when they started their CapEx cycle, when they increased their spending to invest in themselves quite a bit, and so we should see that finally start to reverse comp-wise. Though again, it's goods, which have been getting slammed quite hard, especially e-commerce goods, as people have obviously, if you've read any of those banks or credit cards, they've definitely shifted to travel. Alright, Intel mentioned severe Q2 2022 PC weakness. Notebooks very weak year over year. Their comment is OEMs are trying to reduce inventory at a rate not seen since the last decade. So they've mentioned inventory as a weakness for 2 years now. They did mention 600 million PCs over 4 years old, so they claim that they're likely to refresh soon. Meanwhile, AMD keeps growing 30% year over year. Not seeing any of the slowdown that Intel's talking about. Though again, I don't own AMD. I still own Intel for Mobileye, which I'm probably going to move to whenever they IPO it, hopefully into a weak market where I can get a better price. Apple, I mentioned Q3 should be better than the Q2 just posted. They did say that there's a weakness in wearables Tim Cook doesn't give much information on the call, very little color, very little help. But iPhones are still strong and not able to determine macro weakness in Mac and iPad as the compliance is strained, aka they're selling what they can make still in the Mac and iPad. And iPhone growth is still strong, so really it's just the wearables that were weak so far. Roku is interesting, so it ties into Facebook and Google through YouTube. Mentioned material slowdown in advertising spending in Q2, specifically in the scatter market, which Roku is more levered to, or more exposed to. They did have stronger net ads, but it's due to Walmart's and the world blasting out costly TV inventory at discounted prices. So basically, we're starting to see some disinflation on consumer goods, as all these companies that overstocked inventory are now trying to push it out at lower prices, right? Kind of like a liquidation event. Enbridge, so pipeline, so it's not going to be specific to consumers. But the main notes there to myself, mainline volumes ramping up, still get the Q4 2020 easy comps, so some additional EBITDA on the renewable side from current energy prices. Mentioned 8% of EBITDA protected against inflation. Alright, APCO, basically same idea. They mentioned there's more chatter for future products on the LNG side for structures. Their CU side still doing quite well. Utilities continue to perform as they should during an inflationary environment. I did find that, and they own some ports. It's not a big part of their business, but they didn't say that there was a slowdown yet, which is kind of weird. But they did flag that they do have exposure to Chile exports slowing if volume slows. But again, it's not really a material part of the business. I'm surprised they even break it out still. Starbucks, no slowdown mentioned, which is weird for Starbucks when even Walmart, same people are trading down. You'd expect something, but they didn't mention any slowdown. Actually, he mentioned it's critically important you all understand that we are not seeing any measurable reduction in consumer spending or evidence of consumer trading down. My conjecture there is that it could be that the lowest income consumer wasn't buying $5 coffee to begin with. Uber, so this is one that I nailed, which is nice. So no comment on slowdown given up 100% year over year. The reopening of travel is leading to a strong mobility recovery outplacing any slowdown. It's hard to slow down when the starting point is already down 50%. Mentioned more drivers entering to fight inflation, which is interesting. So they're actually improving quite well. Sorry, my phone just keeps going off, and I'm not gonna edit it out because I'm trying to pump videos this week instead of editing. PayPal is Q2 was another weaker quarter. It's already guided to be a very weak quarter. They mentioned e-commerce growth is relatively flat, and if they took travel out, it might have been actually slightly down. So your payment transactions, like your Visa, your MasterCard, and Amex, all have been putting up really good numbers. And PayPal's been lagging, and that's because PayPal has the e-commerce focus, and Visa, MasterCard, and Amex have a lot more on-premise spending. They also generally have more on their travel. Like, you're not going to put your trip expense on PayPal. You're probably going to put it on your credit card, right? And so we're seeing a big shift there, and also on on-premise spending, people will use their card more than they would on PayPal, right? So we're seeing a decel in PayPal. It's still growing very well and still dirt cheap. I actually own this company. Probably do a video on it at some point. Probably do one on Uber too. I own that one too. Gilead, no comment on slowdown. But Carby, so this is like healthcare. I don't think I've done a video on Gilead. It's another interesting one. Basically, they made extra cash flow during COVID from their Veklury drug, which is remdesivir, which is basically a drug that they're giving people that were on COVID, or that had COVID. And anyway, the sales have been going down on that, but their underlying investments that they've taken with the extra cash flow into oncology appear to be growing finally, and they're trying to push different initiatives. I'll probably do a video on it. There's too much information for me to go through on it. But anyway, they're obviously, when you're healthcare, drug related, you're not going to have that same type of pushback on price increases or stuff like that. Usually when it's your health, people generally don't, it's less price sensitive. Cedar Fair, so this is an interesting one I'm going to start looking at probably in the amusement park side if they get cheaper. Not seeing any meaningful in terms of downshift. Company's still recovering from COVID. Customer behavior is migrating to season pass, which is the company's most expensive ticket, but it's also a ticket that people see more valuable if they're going to go very often to their parks, right? Cedar Fair is like roller coasters. Bell Canada mentioned not seeing any material issues, so it's like Rogers. Now experience a slowdown in customer payment patterns. Paramount Flight weaker scatters, that's what Roku already said, and a weaker digital market. Again, that's what Roku already said. They said that's the main reason for year-over-year decline in TV. They also flagged the macro environment for slower Pluto growth. This time they actually called out which industries are pulling back the most from marketing in their point of view, and that was auto and packaged goods. So again, it falls into the same mosaic. The spending shifted to travels and experiences, memory generations as opposed from goods, right? And everything was shut down. People were buying goods. Primaris, so this is a REIT that I'm actually going to do the next video right after this. The idea this week is just to pump out a bunch of videos and spend no time on editing, or very little time on editing. So we'll see how it goes. But it's just, I hate editing and I love making videos. So Primaris, no slowdown yet. Rather, the enclosed malls in our portfolio experiences significant rebound in tenant sales, with several malls reporting all-time productivity. So that's a weird sentence in this whole list of things. All of a sudden I'm saying goods are doing horrible or relatively bad, but you still have enclosed malls performing, and that tells me that the shopping experience is rebounding, right, from the shutdown. And so we'll have to see how that plays out, if that's sustainable or not. But right now, these companies are still super cheap technically. Probably because the market doesn't believe that the recovery in travel and experiences, like technically shopping is more of an experience, right, than it is going to just buying something on Amazon and a couple clicks online that I could do right now, right? Anyway, so I'm trying to link that to services in a weird roundabout way, but really it's more linked to experiences. Not that enclosed malls is an amazing experience or anything. Pen gaming, not seeing any softness in majority of regional gaming properties or vast majority of markets. They did say similar properties with limited offerings. The target lower or worth segment is only place where they're seeing softness. Expedia, not seeing a slowdown, currently seeing robust summer and Q3 lodging bookings ahead of 2019. Note the higher average room rates and stuff like that are helping Expedia. Sun Life, no comment on slowdown. Mark-to-market investments did hit financials with some retail outflows, so some people are saying all the retail's going in, like maybe they started going in July, but they're definitely net sellers for the first 6 months of 2022, at least at Sun Life. Customer-wise, did notice a great lessening in COVID mortality experience, declining 90% in Q2 versus Q1. So they're noticing a lot less claims from death from COVID during Q2 versus Q1. That's a pretty big deceleration for going down 90% in a quarter. So that's a good thing for humanity. And good for Sun Life too. Commodity play, so for Suncor, again, there's no comment on slowdown, it's the oil play. They did have a production cut. Suncor continues to have production issues, and they still have safety issues. And those things are probably correlated. So I'm still owning Suncor. I've been slowly trimming it, but again, this company is crazy cheap because of these issues. But again, it's cheap on these higher commodity prices, which is always a risk factor. But they bought back 6% of the company in the last 6 months, so that's 1% a month, and they've also have a 5% dividend yield, or 4%, whatever it is, depending where the share price is. These are just notes to myself. I've kind of already talked about the general theme. I think you can kind of tell where my head's at. There's likely opportunity still skewed in small cap growth. That's free cash flow positive. So that's kind of where I'm looking at, is in that area, the smaller guys. But I need the smaller guys to be self-sufficient for me to actually buy them, because I don't want them to be at the mercy of the capital markets, because I think it could get worse, right? You never really know, but that's kind of my hedge. Just make sure they can make it through it. So generally how I'm looking at so far is to find companies still down materially from pre-COVID 2019 levels, and look to see if the company was free cash flow positive in the past, and then filter out the company that must be currently improving year over year with easy COVID comps, so they're currently putting up good numbers versus last year. And then filter to ensure the idea is linked to experience or memory generation. While there's pent-up demand, which is by definition unsustainable, the pent-up demand is continuing during what is likely an ideal period. So what I mean by that is, like, during this recession, you're going to get some more deals. I'm going to be able to buy companies that are currently putting up good numbers and have free cash flow to take advantage of their deals. That's the idea. And generally, they should be still pretty cheap because they're already down from their 2019 highs, even though the business is already recovering past 2019 levels without China for a lot of these things. So assuming they're a global company. Anyway, and then I also want to filter out if the company had to shoot up their balance sheet to plug the weaker cash flow generated in 2020 and 2021, and figure out how they bridge those weaker years. And then the last one is figure out the company's better off coming out of COVID than coming in. So that's my last filter. So that's kind of like what I'm looking at companies at this point based on this information, right? And the easiest ones to avoid right now are lower income apparel, still e-commerce, anything that's still digital advertising. So during recessions, usually advertising's first thing to go. Then you freeze hiring, right? Because those are the things that you can cut back on without damaging your current employee base. And after that, you're going to have to start making harder decisions. Well, cutting marketing is technically a harder decision because it influences your growth rate, right? You're going to grow a lot less. But those are the things that generally get cut fast, and that's what we're starting to see. But at the same time, we're starting to see increase in advertising and spending for travel companies, kind of thing. So you're seeing this weird dichotomy from goods to services. The market's very focused on the goods decreasing more than the services increasing, because they view the services increasing as just pent-up demand, which is probably partially true, but usually the truth is more nuanced than what the headlines would ever imply or suggest. Anyway, that's my thoughts on this video. It's a long one, but like I said, I just want to get it out there. It's kind of how my process works. So next week I'm going to listen to all these calls and save notes and see how it works into this kind of mosaic that I'm trying to get. Then I pull ideas. Like the next one's going to be Primaris, which is a REIT. An idea there is that the utilities outperform the REITs, but I can still get some pretty good cash flow in REITs with some probably better upside over a longer period of time than what the utilities would currently give me, because the utilities are currently priced very well because they perform very well. Whereas the REITs are trading down. We'll go into that actually in a bit, but they're traded down more for different reasons for different industries and different REITs. But anyway, that's kind of my thoughts right now. Hopefully, like this is kind of like how I'm kind of showing you guys how I kind of treat earnings season and the things that I kind of look for. This one's a little bit different because it's more focused on consumer spending, because all the analysts are asking questions on it, so it's easier for me to link them all together when they're all asking the same question to every company that reports like what's happening to your consumer during this harder period of time. Oops, I almost forgot. So for this one, it's kind of like, what's an example of a company that has down at least 50% from 2019 levels, right? But has improved materially, or has recovered materially since then, didn't have to shoot up the balance sheet, and is going to put up some easy year-over-year comps because of a reopening kind of thing. So that's like my example of what this kind of looks like, what fits the ticket for it, right? And then obviously they reduced headcount immediately during COVID, and their profitability margin should go from 8% to probably 10%. So you're making probably 20% more on the same dollar value when it recovers. It's duty-free. I've done a video of this. I'll probably revisit it with the Auto Grill once they've reported and start consolidating the two companies to get a better feel for it. But anyway, this company that's gone from, let's call it 16 in 2017, pretty much straight down to $4. And if we assume this value in here is the fair value around 10, currently it's still very cheap at $3.70. But one of the things that's interesting with duty free and why it fits the ticket for the examples is that it didn't have to shoot up the balance sheet the same. So here you can see the actual performance of the business since April 1st, 2021. And this is as a percent of sales of 2019. Hopefully you guys can see this chart on right here on the left side, bottom left. And basically, what you want to see is up and to the right, right? So the business is recovering quite well, especially lately. As we know, international travel is finally picking back up with restrictions finally easing. And then you have the same period, so let's just go April, right? So you have the share price going from basically $7 to under $4, but you have the business going from down only 33% of 2019 to almost approaching 2019 sales. So these are the type of setups that I like. And then, okay, so the company, obviously, the share price reacted to the negative, right? Because obviously international travel hasn't fully recovered yet. You don't even have China yet, or cruise lines really. But anyway, you can see the share price reacted to negative fundamentals, but then it stopped reacting to the negative fundamentals here. And one of the things I like about duty free that's unique is that unlike other companies that had to bridge the cash flow, like cruise lines still had to bridge all this extra cash flow to keep the cruise lines maintained, right, and the big ships, right. With duty free, you didn't have that huge capex investment, but then you also got the breaks from the airports. So the airports got money from the government to keep the airports open, and the airports turned around and gave forgiveness to the retailers that were in the airports. And duty free, the Dufry is a retailer in an airport, so they also got this forgiveness, which also helped them bridge the pandemic. So imagine getting rent free for a while, right? Because your sales are basically destroyed because of shutdowns that you don't control. So that's kind of what happened. So basically what I'm doing here is, instead of having this lingering weakness for 2 years, it's basically they stabilized it flat, and then they've just been slowly improving. And what I like here is that the share price is getting weaker into this improvement. And this is very steady improvement, right, across different geographies, which you expect, really. It's only getting back to 2019 levels. I think they're going to blow past it, especially once China reopens. But that's just me, and obviously I own this one. Right? Anyway, I'd like to know your thoughts. It's a different video. It's not a company-specific one, like I said. But anyway, have a great rest of your week.